The U.S. dollar had been on something of a tear recently, hitting its peak last September, driven by all those rate hikes and expectations of more to come. But since then, it's given up over 5%, with prospects that the Fed may be nearing the end of turning up the heat. And J.P. Morgan warned this week it may get worse from here. But it's still nothing compared to what Louis Rukeyser was looking at on Wall Street Week back in 1993.
The American dollar repeatedly dived to new post-war lows against the Japanese yen, fast approaching the once unthinkable level of 100 yen to the dollar. And one Japanese financier confided to me that the next logical step would be to revalue, knocking off the last two zeros, so that 1 yen would equal and perhaps even exceed $1. Never mind that many economists seriously question the wisdom of a succession of our own governments whooping the yen higher and the dollar lower, while beating on the Japanese to open their markets wider.
To take us through where we are today with the dollar and where we may be going, we welcome back Bloomberg International Economics and Policy Correspondent Michael McKee.
Unfortunately for Mr. Rukeyser, the dollar continued its dive, in 1995 reaching the once unthinkable level of 80 yen. That was back in the days when American consumers seemed to be buying everything Japan could manufacture. The slide wasn't arrested until Robert Rubin, who became Treasury Secretary just as the dollar reached its nadir, was able to hammer home a new mantra that a strong dollar was in the best interests of the United States. And since then, as you've often heard, markets go up and markets go down. By 1998, the yen had weakened so much, the U.S. was willing to join with other G7 nations to strengthen it. Why? Well, for one thing, the euphemisms strong and weak are quite misleading. There are advantages and disadvantages to both conditions. If the dollar appreciates, it means foreign goods are cheaper to buy. That helps hold down inflation, which means interest rates can stay lower than otherwise necessary. But it also means American exports cost more overseas. If the dollar is depreciating, those exports are cheaper, and U.S. companies can sell more. More foreign tourists can afford to visit, and American assets become more attractive to foreign buyers. Now, some politicians worry about what they call a weak dollar, and it has been depreciating. The dollar rose because the U.S. economy has been much stronger than others, and the Fed's raised U.S. interest rates higher than other central banks. With the Fed almost done, that's changing against many currencies. Currency strategists forecast some dollar weakening, but no crash. It's still historically strong. A drop may disrupt some carry trades and other strategies, but it's not necessarily a bad thing for the U.S. Just sounds bad.